Hello. Once you've determined the cost of the inventory, whether it's periodic or perpetual, using FIFO, LIFO, or average cost, you have one more step, and that is you need to apply the lower of cost or market rule. And basically it says we want to record our inventory at cost, but what if the inventory market price, in other words, the price tag sitting on it, is less than the cost? If so, then you need to write your inventory down to its market value. In other words, you need to make this entry. You'll need to debit cost of goods sold or the loss on inventory write-down and credit inventory. That way the inventory will show at what its realizable value is, which is its market value, what you can sell it for, since it's less than what you paid for it. To show you how to do this, look here. Notice that it says that this company has over voltage protectors and that it had to take a substantial inventory write-down of $12 million. Probably had to do with customer changes in product specifications or obsolescence. So if that happens, we debit the income statement account called loss on write-down for $12 million and credit inventory for $12 million. By doing this, it makes our net income smaller by $12 million and our current assets smaller by $12 million. But in Part B it says, what if after you took this write-down in period 1, that in period 2 you're able to sell it for $48 million cash? Then what would be the entry? Well, first take the money. Debit accounts receivable, credit sales for $48 million. That will push your net income up $8 million and thus your shareholders' equity up $8 million. And you'll debit cost of goods sold for the $40 million, because remember after write-down it was 52 minus 12, meaning the inventory was being held on the books at $40 million. So that's why we debit cost of goods sold $40 million and credit inventory $40 million. By doing this, notice that the write-down of the previous year of $12 million improves a bit, because notice we have profit of $8 million. So we wrote it down too much in the first year, we recovered $8 million in the second year. So it's a way, it's because in accounting we recognize our losses early and we defer our gains. It's also called that, and that's due to conservatism, that we want to do that. We always like to tell the bad news early. It's also a way to plan your net income, because notice by determining that you wanted to do a $12 million write-down, were you able to have a $8 million income in the following year. Now it's not quite as calculated as that, because you really don't know what you're going to be able to sell it for in subsequent periods. Okay, now here's the kicker. Under IFRS, LIFO is prohibited. So, U.S. companies love LIFO because it saves them a lot of income tax dollars. For example, DuPont in previous years have saved over $150 million in income taxes because it uses LIFO. If the U.S. ever totally embraces IFRS and also says no one can use LIFO, there will be an immediate tax burden on all the LIFO companies in the United States, because they would have to pay a lot of taxes because they use LIFO, which gives them a lower net income, thus a less tax bill than would be possible under FIFO. Lower of cost or market and hidden reserves. Because you use LIFO, last in, first out, the ending inventory will be lower, not only because of the LIFO, but because of the lower of cost or market. And so when this happens, it's possible to think about what you want your net income to be. So notice here we have 2 layers under Lifo, and it's saying prepare the income statement for 2014 once dipping into these older layers, and the other one going out and making a purchase of an additional 550 units at $30 each. So let's take a look. Under this method, we're dipping into our older layers, and as you can see, by dipping into our older layers, we are able to get a higher net income. Whereas if we go shopping for that $30 layer at the very end of the year, notice our net income is lower. So using Lifo, our recent purchases of inventory changes the net income and it lowers it. Whereas if we dip into older Lifo layers by selling off the older, cheaper layers, notice it improves our net income. So by timing your purchases and using Lifo, you can have an impact, direct impact on your net income. Here's another example. This is Texaco. They were a Lifo user and they dipped into their Lifo layers by 16%. And notice that that year they were able to transform what would have been a drop in net income into a modest gain. So they were able to plan their net income via their inventory purchasing practices because they sold off or they dipped into those older, cheaper Lifo layers, which released cheaper costs into cost of goods sold. Thus, they were able to move their net income higher than if they would have gone out and bought more inventory. So let's stop there.